Hey guys, welcome back to the Bitcoin Fortress podcast, episode 230. Today is August 23rd, 2026, and we are recording at block height 963753. Moscow time is 1294 sats to the dollar, and fees are about as cheap as they get at 1 and 2 sats per VByte. And what a difference a week makes. Last weekend, Bitcoin was still grinding around the low to mid $60,000 range. Sentiment was lousy. People were tired. Everybody had a reason why Bitcoin wasn't working anymore. Then, Washington intervened in the Treasury market. The dollar fell, gold ripped, Bitcoin ripped, shorts got vaporized, ETF money came pouring back in, and suddenly everyone rediscovered the debasement trade. Funny how that works. Bitcoin traded above $77,000 by Friday after gaining more than 20% during the week, but I don't think the price move is actually the most interesting part of the story. The interesting part is why it happened. The federal debt crossed $40 trillion. Long-term treasury yields reached levels we haven't seen since before the financial crisis. The Treasury Department stepped in to buy more long-duration bonds. Investors immediately began asking whether this was the beginning of some form of soft yield curve control. Gold and Bitcoin responded almost simultaneously, and that is the story. Bitcoin didn't suddenly become more scarce on Wednesday. Its monetary policy didn't change. The network didn't release a new earnings report. What changed was people's perception of the denominator. And longtime listeners know how I feel about those things. So today, we're going to spend a lot of time there. We'll also talk about the surprisingly consequential week in Washington, the return of ETF flows, the changing Bitcoin mining business, Metaplanet's latest treasury move, the continuing evolution of stablecoin regulation, and some very interesting conversations happening around the Bitcoin podcast universe. Then we'll finish with this week's featured Bitcoin Fortress essay, Optionality Is a Form of Wealth, which actually fits today's discussion better than I expected when I wrote it, because ultimately, that's what Bitcoin gives us, not certainty, options. And with that, let's get into it. First category, the fiscal wall. The biggest story of the week came from a place most crypto traders probably weren't watching: the United States Treasury market. Treasury Secretary Scott Bessent announced that Treasury would at least double the size of certain liquidity support buybacks for 10 to 30-year government securities, increasing purchases from $2 billion to at least $4 billion per operation beginning in September. This followed a nasty sell-off in long-term government bonds that pushed the 30-year Treasury yield as high as roughly 5.34%, the highest since 2007. Now, $4 billion sounds enormous to normal people relative to a Treasury market measured in tens of trillions of dollars. It isn't. But markets often respond to signals, not merely size. And the signal was pretty clear. Washington doesn't like long-term yields this high. The immediate reaction was almost textbook. Long yields fell, the dollar weakened, gold surged, Bitcoin surged, and this is where I think Bitcoiners need to resist getting lost in terminology. Is this QE? Technically, no. Is it formal yield curve control? No. But if the largest debtor on earth begins purchasing its own long duration obligations when interest rates become uncomfortable, the distinction starts becoming less important than the incentive structure. The United States has an enormous debt stack that continuously needs to be refinanced. Higher rates aren't merely inconvenient anymore, they are existentially expensive. And once the debt stack gets large enough, the government becomes increasingly sensitive to the price of its own money. We've been talking about this for years. The math may eventually began driving policy. The Bitcoin thesis doesn't require hyperinflation or government collapse. It merely requires policymakers to continually choose the politically easier path when confronted with impossible fiscal trade offs. And that is a much lower bar. Well, almost perfectly on cue, the gross U.S. national debt crossed $40 trillion this week. The progression itself is worth contemplating. The debt reached $38 trillion in October 2025, then $39 trillion in March. 5 months later, $40 trillion. That acceleration matters more than the round number. People sometimes ask me what the end game is for the debt. I don't know. And frankly, I don't think anyone does. But I think we can make a pretty reasonable guess about the path. Politicians aren't going to voluntarily impose the level of spending cuts or taxation required to meaningfully deleverage the federal balance sheet. Voters just simply wouldn't tolerate it. Markets might not tolerate it either. So the more likely path remains what it has been for decades: economic growth where possible, financial repression where necessary, inflation when convenient, and periodic intervention whenever markets begin forcing the issue. That doesn't mean $40 trillion causes Bitcoin to go straight up. Bitcoin spent much of this year falling while the debt continued rising. But it does help explain why an absolutely scarce asset remains interesting over a long enough time horizon. The dollar is an accounting system whose supply is constrained by political incentives. Bitcoin is an accounting system whose supply is constrained by mathematics. That difference seems increasingly important when the debt counter starts adding another $1 trillion every few months. Don't obsess over the debt number itself. Watch the policy responses the debt eventually forces. That's where Bitcoin enters the story. One of my favorite things this week was seeing mainstream financial media use the phrase debasement trade. Reuters explicitly described concern that Treasury intervention could encourage dollar depreciation and noted investors moving toward alternatives. Financial Times described both gold and Bitcoin rallying as investors questioned U.S. fiscal credibility. Think about how far we've come. 10 years ago, saying Bitcoin could someday trade alongside gold as protection against monetary debasement got you dismissed as a crank. Now it appears in mainstream market wrap ups. Gold surged above $4,500 during the week, Bitcoin surged above $77,000, and they moved for many of the same reasons. This doesn't mean Bitcoin and gold are identical assets, they're clearly not, but they share one extremely important characteristic. Nobody can create more of them because a government financing problem has become inconvenient. Gold answers to geology. Bitcoin answers to consensus. Fiat answers to policy. And when confidence in policy gets shaky, hard assets suddenly become interesting again. I've said this before on the show, the best Bitcoin marketing campaign in the world is usually the fiscal system itself. Sometimes it just takes a little while. Ray Dalio joined the conversation this week, warning that the U.S. could face a serious sovereign debt crisis within several years if fiscal trends don't change, and again, pointing toward gold and Bitcoin as potential hedges. Dalio and Bitcoiners obviously don't agree on everything, but he's been studying debt cycles longer than most of us have been investing, and his framework is useful because the problem he describes isn't ideological, it's arithmetic. Governments borrow, debt service grows, eventually policymakers must choose among taxation, austerity, default, financial repression, currency depreciation, or some combination of them. Historically, currency depreciation is among the least politically painful. People notice a tax bill. They don't always notice a denominator slowly changing underneath them. That's why I continue to think inflation is better understood as a process than a CPI number. The dollar can buy fewer houses, fewer stocks, less gold, less Bitcoin, and yet because the price of your coffee didn't double this month, we're told inflation's under control. Again, change the denominator. Dalio isn't predicting that Bitcoin replaces the dollar tomorrow. Neither am I. The case is much simpler. If policymakers must choose between protecting the purchasing power of the currency and protecting a highly leveraged financial system, history tells us which side usually wins. Next, Bitcoin wakes up. Bitcoin entered the week around $63,000 to $64,000. By Friday, it had traded as high as roughly $79,500 before settling back. That's an extraordinary move in a very short period of time, and I think there are two ways to interpret it. The trader interpretation is that Bitcoin broke resistance, shorts were caught off sides, momentum returned, and maybe the bull market is back. Fine, maybe. But the more interesting interpretation is that Bitcoin once again behaved exactly as you'd expect a scarce bearer asset to behave when market confidence in sovereign debt becomes unstable. That's not always what Bitcoin does in the short term. Sometimes Bitcoin trades like leveraged tech. Sometimes it trades like a liquidity sponge. Sometimes it trades like a risk asset. And occasionally it reminds everyone what it was built to be. I don't know whether $60,000 was the bottom. I don't know whether we're going to go back to all-time highs this fall. And I don't think we need to know. What matters is that the network continued producing blocks throughout the entire drawdown. Nobody changed the 21 million cap or held an emergency meeting or bailed out Bitcoin. And then when the macro environment shifted, price adjusted. That is what a functioning market looks like. The speed of the move was amplified by a historic short squeeze as Bitcoin broke through the range that has trapped it around 62,000 to 67,000. Traders who had bet on continued weakness were forced to buy Bitcoin back to close positions. AP reported that more than $4 billion in bearish crypto positions had been liquidated by Friday. The block reported approximately $2.75 billion of shorts liquidated earlier in the move as Bitcoin passed 72,000. This is the one reason I continue to think leverage is such a terrible way to own Bitcoin. Bitcoin itself is already volatile enough. Why add an expiration date to your thesis? The irony is almost perfect. People who simply owned Bitcoin and did nothing survived the drawdown. People who became convinced Bitcoin was dead and leveraged themselves against it got liquidated in about 48 hours. Bitcoin has a strange way of punishing certainty in both directions. That's another reason I've become increasingly comfortable simply building the position, securing it properly, and letting time do the heavy lifting. You don't have to catch every move. You mostly have to avoid blowing yourself up. Wednesday's rally brought institutional flows roaring back. U.S. spot Bitcoin ETFs recorded roughly $517 million of net inflows, their strongest day since May 4th. BlackRock's IBIT alone took in approximately $285 million. Fidelity brought in about $62 million, and 8 of the 12 funds were positive. This is important because ETF flows had been one of the big weak points during the drawdown. And it reminds us that institutional adoption does not move in a straight line. Capital doesn't wake up every morning asking how many Bitcoins it can buy. Institutions allocate based on liquidity, risk budgets, interest rates, volatility, macro conditions, and portfolio construction. When those inputs become hostile, money leaves. When they improve, money returns. The infrastructure remains. That is a massive difference from previous Bitcoin cycles. In 2018, when sentiment disappeared, the financial rails largely disappeared with it. Today, the pipes are still there. BlackRock doesn't need to rediscover Bitcoin. Fidelity doesn't need to build the ETF again. Registered advisors don't need Congress to invent brokerage accounts. The infrastructure exists. Capital can simply come back through the pipe. And this week, it did. BlackRock also published an interesting reassessment of Bitcoin following the big correction. Their conclusion was essentially that the sell-off was driven largely by leverage and flow dynamics rather than a collapse in Bitcoin's investment thesis. They continue to describe Bitcoin as an emerging global monetary alternative and portfolio diversifier. That language matters, not because BlackRock is some oracle, but because this is how normalization happens. Bitcoin doesn't need Larry Fink to save it. It needs institutional participants to stop treating a 40% drawdown as proof that the asset has ceased to exist. And increasingly, they aren't. They're finally starting to analyze the leverage, positioning, allocation sizing. They're analyzing Bitcoin the same way they analyze every other asset. And honestly, that's boring. But boring is progress. Bitcoin's transformation from magic internet money to something global asset managers routinely discuss in portfolio construction language is one of the biggest cultural changes of the last decade. Price gets all the attention, normalization may matter more. Next up, Washington builds the rails. President Trump used a White House event this week to once again call for passage of the Clarity Act, describing the legislation as important to maintaining U.S. leadership in digital assets. Executives from Coinbase, Kraken, Robinhood, NASDAQ, ICE, and other firms attended, and a smaller group subsequently met with the president in the Oval Office. According to reporting from The Block, Trump appeared bullish about getting clarity through Congress, with a procedural Senate vote scheduled for September 15th. But the bill remains messy. There are disputes over stablecoin rewards, there are illicit finance concerns, there are ethics questions surrounding politicians' involvement in crypto ventures, and the calendar is getting tight ahead of the midterms. So I remain cautious here. I've said for months that the most interesting question isn't whether Washington passes crypto-friendly legislation. It's what powers get embedded inside the architecture while everybody celebrates regulatory clarity. Surveillance requirements matter. Custody rules matter. Reporting requirements, permissionless activity, stablecoin restrictions, all of that matters. The Bank Secrecy Act originally looked like bookkeeping. Decades later, it became foundational financial surveillance infrastructure. So, yes, regulatory clarity can be good, but clarity about what? Keep reading the fine print. Perhaps more consequential than clarity itself, the SEC proposed a new framework called Regulation Crypto Assets. The proposal creates tailored pathways for digital asset fundraising and includes exemptions for smaller offerings, plus a safe harbor mechanism allowing some assets to cease being traded as securities once managerial efforts have ended. What's fascinating is the political message underneath it. Washington regulators appear to be saying Congress can act. But if Congress doesn't act, we're moving anyway. White House crypto advisor Patrick Witt essentially described this as the administration's break glass option. That tells us the direction of travel is increasingly set. The American government has moved from trying to contain digital assets to trying to domesticate and regulate them. That distinction matters. It may be good for businesses, it may be good for institutional adoption, but Bitcoiners should always remember that Bitcoin's most valuable characteristic is precisely that it does not require an SEC exemption to exist. Companies need regulatory pathways. Bitcoin doesn't. That's a feature. The OCC says it intends to finalize rules implementing the Genius Act by November, ahead of the law's January 2027 effective date. The framework covers reserves, liquidity, redemption, auditing, custody, risk management, and the wind down of stablecoin issuers. This sounds like plumbing because it is, and plumbing matters. Stablecoins are becoming dollar distribution networks for the internet. The interesting irony is that the same world increasingly concerned about dollar debasement is simultaneously building technology that may dramatically expand global demand for dollars. Those ideas aren't contradictory. The dollar can weaken against scarce assets while becoming even more dominant as a payments network. I've described this before as two monetary systems developing simultaneously. Stablecoins make fiat more technologically competitive. Bitcoin makes fiat more monetarily accountable. One improves the rails, the other changes the unit being transported, and I suspect both are going to be enormous. Trump also said the CFTC is working on a pathway to bring perpetual futures trading platforms such as Hyperliquid into the United States under compliant regulatory structures. I don't particularly care about the hype token, but I care about the underlying trend. For years, American policy effectively pushed crypto markets offshore. Then everyone acted surprised when trading migrated to opaque offshore exchanges. Now Washington is trying to reverse that. This is another example of the shift from prohibition to integration. Traditional exchanges like CME and ICE increasingly find themselves competing with markets that operate 24 hours a day, 7 days a week, settle almost instantly, and don't respect banking hours. Technology tends to win these battles eventually. The question is how much of the old infrastructure survives in the new architecture? Bitcoin itself is already global and always on. Increasingly, traditional finance is being forced to become more Bitcoin-like, not ideologically, operationally. That may prove to be one of Bitcoin's quietest legacies. Next up, corporate Bitcoin grows up. Metaplanet announced a fascinating transaction this week. The Japanese company plans to contribute 2,100 Bitcoin plus $2.5 million in cash into NASDAQ-listed Super League Enterprise. Super League will be renamed Superplanet, and Metaplanet is expected to own roughly 95.7% of the company. Metaplanet currently holds around 43,000 Bitcoin, making the 2,100 BTC contribution less than 5% of its stack. This creates something unusual, a Bitcoin Treasury strategy spanning both the Tokyo Stock Exchange and NASDAQ. And I have mixed feelings about this entire corporate Treasury phenomenon. On one hand, it demonstrates how powerful Bitcoin is becoming as corporate collateral and reserve capital. On the other hand, we should distinguish between owning Bitcoin and owning an elaborate financial structure that owns Bitcoin. Those are not the same risk. Bitcoin has no CEO. Treasury companies have CEOs, debt, equity issuance, preferred securities, governance risks, index risks, and refinancing risks. Sometimes complexity creates opportunity. Sometimes complexity merely creates more ways to lose money. So I continue to view Bitcoin itself as the cleanest expression of the thesis, but Metaplanet's expansion is still significant. Bitcoin is increasingly becoming capital that can be moved between corporate structures, jurisdictions, and security markets. And that is a new phase. Strategy stock has had a rough 2026 and at points significantly underperformed Bitcoin itself. That should not surprise us. Strategy isn't Bitcoin. It's a leveraged corporate wrapper around Bitcoin with operating expenses, capital market strategy, preferred stock, debt, and management decisions layered on top. When the premium works, shareholders can outperform Bitcoin. When the premium compresses, the same leverage works in reverse. I don't think that makes strategy bad. I think it makes strategy different. And as more Bitcoin treasury companies emerge, investors need to stop treating holds Bitcoin as an investment thesis. You need to ask, what are the liabilities? What are the financing costs? What is the maturity schedule? How much dilution is occurring? What is Bitcoin per share doing? Can management access capital during a bear market? Those questions all matter. Bitcoin doesn't care whether Michael Saylor can refinance a preferred security. Bitcoin will produce another block. This is exactly why I like separating Bitcoin risk from company risk. The company may be brilliant, the asset is still cleaner. MSCI recently proposed methodology changes that could potentially exclude companies such as Strategy and Metaplanet from certain global indexes if they are deemed more like investment vehicles than operating businesses. The proposal predates our formal news window by a couple of days, but it remained a major conversation this week and belongs in the larger Treasury company discussion. This is a perfect example of hidden second-order risk. A company becomes popular, its stock enters indexes, passive funds must buy it. That increases liquidity and potentially its valuation. The company uses that valuation to raise more capital and buy more Bitcoin. Beautiful flywheel. Until an index provider changes the rules, then the flywheel can rotate backward. Again, none of this changes Bitcoin, it changes the wrapper. That's why I keep coming back to the same principle. Know what you own. Owning Bitcoin and owning a company whose strategy depends on continually accessing capital markets are two different investments, but they may both work, but they fail differently. The network underneath everything is the next section. Publicly traded Bitcoin miners have reportedly reduced Bitcoin computing capacity by roughly 21% across 3 quarters as operators divert power infrastructure toward AI and high performance computing. This trend fascinates me because for years people treated Bitcoin mining as some strange isolated industry. Now AI companies are discovering what Bitcoin miners already knew. Power is the scarce asset. Grid access is valuable. Interconnection agreements are valuable. Substations are valuable. Land near energy, valuable. And flexible loads, also valuable. Bitcoin miners spent a decade locating stranded and underutilized energy because their machines could operate almost anywhere. Now AI wants many of those same electrons. That creates competition, but it also validates the infrastructure Bitcoin miners built. The most interesting mining companies may eventually become energy companies that could dynamically allocate power between Bitcoin mining, AI compute, and grid services depending on economics. That doesn't weaken Bitcoin. Hash rate follows incentives. If some publicly traded miners leave, more efficient operators eventually fill the gap. Difficulty adjusts, blocks continue. The system was designed for exactly this. Bitcoin mining doesn't require today's miners. It requires someone, somewhere, willing to exchange electricity for Bitcoin at the right price. Someone always is. Before the Treasury intervention, Bitcoin was showing an interesting form of relative strength. The 30-year Treasury yield pushed above 5.3%, Brent crude moved above $91, stocks weakened, and Bitcoin still held near $64,000. That got my attention, not because $64,000 was magical, but because Bitcoin had every excuse to fall apart. Higher oil increases inflation pressure. Higher inflation keeps rates elevated. Higher yields increase the opportunity cost of owning assets that don't generate cash flow. Normally, that combination is terrible for Bitcoin in the short term, yet Bitcoin held. Then the macro catalyst reversed and the market exploded upward. Markets often turn before the narrative does. Nobody rings a bell. By the time everything feels comfortable again, price has usually already moved. That's why trying to emotionally time Bitcoin is so difficult. It often feels worst near opportunity and safest near excess. The solution is boring. Size the position correctly, don't use leverage, keep some liquidity, and give yourself enough time. The fallout from the Coldcard entropy vulnerability remained a major topic in Bitcoin circles this week. What Bitcoin Did devoted an August 21st episode to Lloyd Fournier and Nick Farrow explaining the failure, which reportedly affected seed generation and contributed to more than 1,700 Bitcoin being stolen from vulnerable setups. This story remains painful because it strikes at something Bitcoiners properly consider sacred, self-custody. But I think the lesson isn't that self-custody failed. The lesson is that single points of failure remain single points of failure, even when they come wrapped in sophisticated hardware. A hardware wallet is a tool, not magic. Multi-sig helps, geographic distribution helps, independent key generation helps, open scrutiny helps, and simplicity helps. The mature version of self-sovereignty isn't trust nobody. It's understanding exactly where trust exists and minimizing the consequences when one component fails. That's a much more useful mental model. Moving on to the Bitcoin podcast universe, there were several interesting conversations around the Bitcoin podcast universe this week, and they fit today's themes unusually well. What Bitcoin did. Bitcoin is running out of sellers with Checkmate. That was on August 18th. I actually happened to catch that one myself. Checkmate's argument centered around seller exhaustion. Bitcoin rises not simply because buyers suddenly become euphoric, but because eventually fewer holders remain willing to sell at prevailing prices. That episode was released basically right before Bitcoin exploded out of its range. Good timing. The idea fits Bitcoin's monetary structure beautifully. Unlike a company, Bitcoin cannot issue additional shares because the market demands them. Supply cannot respond to price. Price must respond to supply. Long-term holders gradually remove coins from liquid circulation. New buyers arrive. Eventually, there's an imbalance, and Bitcoin reprices violently. That's exactly what we saw this week. What Bitcoin did, the Coldcard disaster, everything you need to know, August 21st, with Lloyd Fournier and Nick Farrow, as we mentioned earlier. This was the other major WBD episode this week, and probably the most important from a practical Bitcoin perspective. They went deep into the Coldcard randomness failure, the vulnerability of generated seeds, why firmware updates alone can't repair previously compromised seed material, and the broader benefits of distributed key generation and threshold systems. This conversation should make every serious Bitcoiner review their custody architecture. Not panic, review. Those are different things. TFTC, Chase Koch, the operating system for a free society. That one was on August 19th. Marty Bent sat down with Chase Koch for a wider discussion about the institutional architecture necessary for a genuinely free society. This fits a broader evolution I've noticed in Bitcoin conversations. The interesting thing Bitcoiners are increasingly talking about is less about Bitcoin price and more about what kind of society Bitcoin enables. Energy, food, AI, speech, privacy, education, entrepreneurship, family, local institutions. Bitcoin is becoming less of an isolated financial trade and more of an organizing principle around independence and optionality. That direction resonates deeply with where my own writing and thinking has been going. TFTC Bitcoin Brief, implicit yield curve control is here from August 19th. This one directly overlaps our top story. Marty described Treasury's larger long end buybacks as a form of implicit yield curve control and tied it to the increasingly difficult federal debt math. You don't have to agree with the exact terminology to understand the broader point. Policymakers are becoming increasingly sensitive to long-term interest rates because the debt structure leaves them little choice. That's exactly the dynamic Bitcoin was designed to escape. TFTC Bitcoin Brief. Bitcoin is ringing the fiscal alarm from August 21st. Marty followed that with another piece framing Bitcoin's rally as a reaction to fiscal conditions rather than mere crypto speculation. I think that's the right lens. Bitcoin wasn't screaming alt season. Bitcoin was screaming something is happening in the denominator. And gold was saying the same thing. And that is the signal that I'm watching. This week's Bitcoin Fortress featured essay is Optionality as a Form of Wealth. And in some ways, today's news provides the macro version of the same argument. Most people define wealth as a number, net worth, salary, portfolio size, house value, but I've increasingly come to believe that the most useful form of wealth is optionality. Can you leave the job you hate? Can you handle a market crash without selling assets at the bottom? Can you help your family? Can you take 3 months off? Can you ignore whatever financial emergency happens to be dominating television this week? Can you say no? That's wealth. Bitcoin can become part of that architecture because it exists outside many of the traditional systems that constrain us. But cash creates optionality too. Skills create optionality. Low expenses create optionality. Time creates optionality, and relationships create optionality. And one of the things I've been thinking about more as I get older is that accumulating forever misses the point. The purpose of building a fortress isn't to spend your entire life adding another brick. Eventually, the fortress is supposed to give you freedom to live. That's what this week's essay is about. And if you're new to the show, I've now written 4 Bitcoin Fortress books. Bitcoin Fortress, a simple guide to Bitcoin for beginners, Bitcoin retirement and estate planning, the Bitcoin lifestyle, and the newest book, The Architecture of Money. The architecture of money grew directly out of the macroeconomic series we worked through here and on Substack, looking at how debt, monetary policy, demographics, energy, and technology shape the financial architecture around us, and ultimately why Bitcoin fits into that picture. And I've already started working on what may become the next book. Interestingly, it's looking less like another book strictly about Bitcoin and more like a book about sovereignty itself. Money, work, time, health, attention, family, and enough. Finding a life with enough independence that you actually get to choose what you do with your years you have left. The working idea is the sovereign life. We're still building it, but I think it's going somewhere really interesting. So that's it for episode 230. And I think the lesson from this week is remarkably simple. Bitcoin didn't change. The world around Bitcoin did. The United States crossed $40 trillion of debt. Long-term borrowing costs became uncomfortable. Treasury stepped into the bond market. The dollar weakened. Gold moved. Bitcoin moved. Short sellers got crushed. ETF capital came back. And suddenly the market remembered why a scarce monetary asset just might be useful. Maybe this rally continues. Maybe it doesn't. I have no idea. But I don't think that's the important question. The important question is whether the underlying incentives that made Bitcoin interesting in the first place are getting stronger or weaker. So pay attention to these things: the debt, deficits, political difficulty of austerity, demand for lower interest rates, expanding financial surveillance architecture, capital controls around the world, governments scrambling to regulate digital money. And then look at Bitcoin. 21 million, roughly 10-minute blocks, no emergency committee, no monetary press conference, no Treasury secretary, no bailout. It just keeps going. That's the signal. Everything else is noise. Take care of yourselves, take care of your families, protect your keys, build your fortress, and I will talk to y'all next week. Bye-bye.